Greetings, folks. Welcome. There are a number of tools that economic development practitioners and researchers can use to study the economy of regions. We talked about location quotients and shift share analysis, and in this video, we'll cover trade area analysis. I think that trade area analysis is a great complement to location quotients and shift share because trade area analysis focuses on the retail sector of regions. And although most regions focus their economic development efforts around sectors such as biotechnology, high-tech companies, financial services, information technology, and manufacturing, the retail trade sector is important to regions because it's where residents and tourists to the area spend a lot of their money. People buy groceries, clothing, building supplies, TVs and cars, and lots of other stuff. So trade area analysis is yet another tool, or actually a set of tools, for providing descriptive information about a region's economy. Specifically, trade area analysis quantifies the size of a region's retail market in terms of numbers of customers served and the overall strength of the local retail sector. The first trade area concept that we'll cover is called trade area capture. Trade area capture is a measure of the number of customers that are available for retail purchases in the region that you're studying. And I should say this is calculated by a specific retail sector. Or more simply put, it's the number of customers that are served in the market. And to be clear, this number can be, and usually is, different than the population of a region. Here's an example of what I mean by trade area capture. Let's imagine a town named Toddsville. And even though Toddsville only has 40,000 residents, there are lots of grocery stores, and sales in those stores are so high that it's equivalent to selling to 60,000 people. So although the population of Toddsville is 40,000 residents, the trade area capture for grocery stores, and this is the specific type of retail that we're looking at here, is 60,000 people. To calculate trade area capture for a retail sector in your region of interest, you first calculate the per capita expenditure in the sector at the state level. This gives you an idea of how much the typical person spends per year. For example, you would calculate per capita expenditures on automobiles if you were studying auto sales, or you would calculate per capita expenditures on groceries if you were studying grocery sales. Also, you calculate an income adjustment factor that is local per capita income divided by state per capita income. So if local per capita income is twice as large as state per capita income, then the income adjustment factor is 2. The income adjustment factor is based on the idea that certainly for most goods and services, people with higher incomes tend to spend more money. So if you are basing the trade area capture on state per capita expenditures in the retail sector that you're studying, you want to adjust that amount either up or down, depending on whether local per capita income is higher or lower than state per capita income. If you multiply the state per capita expenditure in the retail sector that you're studying by the income adjustment factor, you get an estimate of how much money someone in your region is spending in that retail sector that you're studying. Finally, if you divide actual local retail sales in the sector that you're studying by the estimated amount that someone in your region is spending in that retail sector, you get trade area capture. And again, this is the number of customers that the particular retail market is serving. As an example, let's say that the state per capita expenditure in the retail sector that you're studying is $1,000, and local per capita incomes are 20% higher than state per capita incomes. So then next, you would estimate that locals spend about $1,200 per person in the retail sector. If actual retail sales in the sector is $180 million, then the trade area capture is 150,000 customers. The second trade area concept that we'll cover is called pull factor analysis. A pull factor tells us the proportion of sales generated by customers from outside the area. To calculate the pull factor, you divide the trade area capture, and that was something we just talked about a moment ago, by the local area's population. A pull factor greater than 1 tells us that the retail sector, again, it could be grocery stores or auto dealers or shoe stores or even clothing stores, is pulling in customers from outside the area. So a higher pull factor implies a stronger retail sector. On the other hand, a pull factor of less than 1 means that the local retail sector is serving fewer customers than the population. In other words, some local residents are actually shopping for the type of retail that you're studying outside the region. For example, a lot of really small towns have pull factors for automobile sales that are less than 1. This means that people in these small towns are going elsewhere to buy a car. It could be the closest larger city that is likely to have a greater selection of auto dealerships. Let's go back to the earlier example where we had a trade area capture of 150,000 customers. If this area happens to have a population of, say, 100,000 residents, then the pull factor is 1.5. This means that the number of customers served by the local retail sector is 50% higher than the area's population. We can use pull factors to estimate a region's potential retail sales, or the amount of sales that you would expect in a city of your size. To calculate potential retail sales, the first thing you do is calculate pull factors for similar sized places. And I should note this is not an exact science, but if the region that you're studying has, say, 100,000 people, then you might calculate pull factors for cities with between 75,000 and 125,000 people. Again, this range gives you places of a similar size to your region with 100,000 residents. Next, you calculate an average pull factor for these cities, which you indicate as PF star, where the star reminds you that it's an average. It's important that if you're studying several types of retail, for example, you could be looking at auto dealers, grocery stores, and say music stores, that you calculate a different average pull factor for each type of retail. That's because the pull factors for these different types of retail are likely to be different. Once you've calculated the average pull factor for the similar sized cities, you can calculate a region's potential sales. And again, the potential sales are for a given type of retail. It could be automobiles, it could be grocery stores, it could be shoe stores. Potential sales are calculated as the region's population size. You multiply that by per capita retail expenditures in the state, of course, for the given type of retail that you're studying. You multiply that by the income adjustment factor, and you multiply that by the average pull factor, of course, for the type of retail that you're studying in similar sized cities. You might notice that I wrote out the income adjustment factor as PC county income divided by PC state income, where the shorthand PC stands for per capita. When we talked about the income adjustment factor earlier, I wrote it out as per capita local income divided by per capita state income. And this time it's per capita county income divided by per capita state income. The reason I'm calling it per capita county income now is because certainly for a lot of states, the county level is the lowest level of geography where you can get retail sales data. So in a lot of cases, you're actually doing this type of analysis for counties, so it makes sense to use per capita income at the county level. At any rate, after making the calculations, you get a dollar value of potential sales for the given type of retail in the region that you're studying. And that potential will be larger in places with higher populations, in types of retail where people tend to spend more money, as represented by per capita expenditures in the state, in places with higher incomes, as represented by the income adjustment factor, and in places with higher average pull factors based on similar sized regions. So you can think of potential retail sales as the amount of retail sales that you would expect in that retail sector in your city or town that you're studying. Once you've calculated potential sales for the type of retail that you're studying in your region, you can compare those potential sales to the actual amount of sales in the type of retail that you're studying in your region. If actual sales exceeds potential sales, then you have what's called a surplus. In other words, a surplus implies more sales than you would expect. If actual sales are less than potential sales, then the difference is negative and you have a leakage. The leakage implies less sales than expected. And I should point out that just because a region has a pull factor greater than 1, which of course means that trade area capture is larger than the area's population, this does not mean that the region is guaranteed to have a surplus. For example, the region you are studying could have a pull factor that's greater than 1, but if the similar sized cities you are using to calculate the average have pull factors that are even higher, the region's actual sales could be less than its potential, In other words, it could have a leakage despite the fact that the pull factor is greater than 1. In a different video, I will show you how to calculate these trade error methods in an Excel spreadsheet. See you then.